Hi, I wanted to talk a little bit about why the market is so strong. I think it surprises a lot of people. You've seen the conflict in the Middle East last much longer than people expected. Oil prices have remained elevated. Ultimately, that should have an impact on the economy. Obviously, the Fed is in a more difficult situation as far as being able to reduce interest rates. Yet the market continues to climb to all-time highs. And ultimately, it gets to increased operating efficiencies by companies. So, as we've gotten into earnings season, you've seen companies utilizing technology, which includes AI, in different ways, and you're actually seeing operating efficiencies materialize. When you see that, you're seeing operating margins rise, you're seeing earnings at the bottom line increase, and you're seeing multiples expand. And to give you an idea of how large of an increase and how rapidly expectations have been going up regarding earnings expectations for this year, if you go back to October of 2025, people were expecting the earnings growth for the S&P 500 to be up just over 14%. And that's a pretty nice year. I mean, that's great year over year earnings growth, especially considering we had a decent earnings period in 2025. If you look at April, the earnings expectations had been revised up to 18% year over year growth. And as of May 1st, that earnings growth expectation is over 22%. Now, some of that is certainly coming from oil and gas companies, which are doing very well in this environment, but a lot of them are coming from more industrial type companies, companies that you really haven't seen good earnings growth from. And while the revenues might be picking up a little bit, revenue growth has been more constrained, but it really is this increased operating efficiency. And I think there's a good chance that we're going to continue to see that through 2027. It's part of the reason that we've got the higher weight towards value companies and the dynamic asset allocation model. So thank you so much.